Hello everyone, it's your boy Captain Joe here from Fishing for Pips. Let's kill it in financial markets 2026. I'm going to share with you guys some knowledge about, dominating the best of both worlds. Understanding the pros and the cons between them, but two beautiful industries. I love stocks and trading with options, and I also love Forex. Yep. Now, so let's dive into it. So when we look at the stock side, we're looking at data sets. So there are over 2,200 stocks. Nice, that we can deal with in the stock market. But we cannot stay between mid caps and large caps because we're looking to achieve something within volatility and stuff. So we cannot stay between mid caps and large caps. But we got this, check out this data set, 2,200 stocks to choose from. In Forex, between majors, pound pairs, euro pairs, some other minor pairs, look at roughly 28 pairs on our watch list. So just look at the data set. Stock market, you're dealing with a lot of companies, S&P 500, nice, you're dealing with a lot of different companies and stuff, nice, where you can do value investing and also trading. Alright, Forex, well, we're dealing with the market makers, yeah, the ones who make up the markets, so we're following their template, the cycles, levels, comps, peak highs, peak lows, resets, continuations, reversals, nice freezes of the markets, and we dominate that with the levels and comps, alright, and the dealer's template, running the market maker cycles. Alright, so when we look at Forex, remember Forex is short for foreign exchange. It doesn't mean just currencies. So when we talk about Forex, people always have this concept about currency trading. Forex is short for foreign exchange, which means God created every nation, every kingdom, every country with unique resources in them, and they exchange it with different countries. That's called bartering business model. They exchange it with different countries, and that makes the world go round. So when you look at Forex market, there's a lot of different instruments, pairs, assets that can be traded there. It's commodities, corn, wheat, energy, currencies, metals, precious metals. And there are so much things inside there that can be traded. So it's not just about currencies. Yeah. So always remember, Forex means foreign exchange. Countries' resources being exchanged. Online, there could be currencies involved, but you're literally investing in many different assets and instruments surrounding what the transactions that are taking place between countries. Alright, stock market, you're dealing with the companies all over the world, all big, large brands, and you're trading these companies' stocks, the stock prices, and whether the stock price is going up or down. And the Forex, same thing, we can trade price going up or down and make money. You're doing value investing here, long only make money when the market goes up. Can't take advantage of leverage. You don't have lot sizes over here. Here, you got lot sizes. You can take advantage of leverage. So you need to understand the difference between the both worlds. But look at the data set. 2,200 stocks. 28 pairs, roughly. Good pairs that we can track and follow all the time. This is the largest Forex market, is the largest financial markets in the world, not the stock market. The stock market is probably approximately $300+ billion, and then Forex is approximately $7+ trillion. Yeah, but it doesn't mean you're just going to jump out and take trades and make millions of dollars and make money and do all kind of craziness and make money. Alright, you will go in there and lose all your money and spend years, waste time, effort, and energy and get nowhere. You got to know what you're doing properly, get the right information, the right education. So, understand, 2,200 stocks, 28. Look at the data set. Could always generate more ideas here than over here. At any given time, you have a lot more potential of building good portfolios here and being very consistent in trading than over here. But here, Forex moves more than stocks. Nice, it's pretty much more volatile than stocks, because here we have news events coming every week, every month, which we call catalysts. The catalyst in stocks comes in earnings. Sometimes it comes on a monthly or it comes on a quarterly. So once a month or once a quarter. Now we don't want that. We want to be able to move between the week. So we do take advantage and we do the best of both worlds according to how things line up. If here is slow, we can drill here. If here is slow, we can drill there. But we are exposing ourselves to the best of both worlds. Right? So when you look at the stock market, we are trading with options. Options have 100 multiplier in them. Put option and call option. 100 multiplier, we trade volatility. Same framework. We build a long short portfolio. We do it on Forex and we do it on stocks too. Nice. It's just here we have to drill through companies to get biases. Here we have to drill through the market maker template to get our biases. So we just have to go through different approaches when it comes to generating trade ideas, direction, getting biases. Nice. But also the platforms that we use in Forex trading brokers, stock brokers. It's different when it comes to premium. We are paying a premium, right, for option, and that's what we risk in. Whatever premium we pay, that's what we risk. Here we have to use our lot size, so we got to control our lot size. Nice, and then we have our leverage. Nice, then we got our leverage. So we understand how to operate in different scenarios. Here we have time against us because when you buy an option, it have an expiry date. So you have to be right within a certain period of time. Otherwise, the contract will expire worthless. So that's why we need the earnings that come out sometime once a month or even once a quarter. Q1, nice, once a quarter or once a month. Here we have NFP, we have FOMC, we have CPI, we got PPI, nice, we got GDP, nice, we got so many different, we got so many different news events coming in almost weekly. So these are catalysts. So look at the catalysts on the stock side and look at the catalysts on the Forex side. So we get here moving much more than here. And we got to be right here within a period of time. But here, we do not have time against us. There's no time against us when we're in a trade. So whether that trade take a month, 2 months to move, it doesn't matter. There's nothing to expire. We could hold that trade on for however long. Here, it's going to expire. So once we put in our position on here, we have to make sure that the earnings is nearby because we want the stock to move big when the earnings come out. Nice, and that is catalyst to push price for us to actually make money. Here we just position ourselves with the dealer template, the dealer cycle, and as these things coming out every week, it keeps pushing price, pulling it back, pushing it, and the volatility plays out over a period of time. Nice, so when we look at the advantage, we could limit our risk here, but here we could limit our risk even much better. Because why would I buy 500 shares? Why would I just buy the stock outright? Why would I just buy shares when I could actually use options? Why would I buy 500 shares of Apple stock? 500 shares of Apple stock. Let's say Apple stock trading at $40 per share. So if I had to buy 500 shares at $40 per share, it's going to cost me 5 for 20,000 US dollars, 20,000 USD. But one put option or one call option has 100 shares in it. So if I buy 5 call option, I end up with the same 500 shares. So I end up with the same 500 shares because I buy 5 call option with 100. Yes, baby. Hi, honey. I had 500 shares. Right? With one call option, 5 call options, 500 shares, 100 per option. And what happens there? Tell me. I could just pay a $2 premium for that. So $2 premium for 5 call options. I expose myself to just 1,000 US. So look at a $20,000 exposure to a $1,000 exposure. And when the price actually move, you're making good money. When you buy $20,000 shares and the price move, you just get a dollar value return. So it's a very low risk, low reward. Very low risk, low reward. When we use the option, we have high risk. When we use the options, we have low risk, high reward. So we get to stack the odds in our favor more there. When we're using something here, if we have a $1,000 account, we take 10% out of it. So we have $100 to expose in our trade ideas. We got 3 longs, we got 3 shorts. Nice. If we say, well, okay, we're using 50, we're using a 50 pip stop loss on each position, equally weighted, and we're using a 0.10 lot size. So each position here will be $5. Each position will be $5. That's 50 pips multiplied by 0.01. So $15 for the long positions, $15 for the short positions. And that's how we kind of control our risk and stuff on this side. And time is not against us. But even though we can limit our risk here and have good control, all we could lose is the premium if everything go wrong. But we can have unlimited upside potential if the market goes in our direction. And we're building portfolios with that, with put option and call option, if we believe the stock going to rise or fall. Nice. Here we have to do it a little different when it comes to lot size and stuff. Here we are building the portfolios with the option structure. So we get stock market direction, right? We drill through the stocks, we look at the sector, we go through the qualitative work, quantitative work, macroeconomics, microeconomics, get all the outliers, go drill through the company, right? See how the company going, get all the data possible, do all the historical data. We know where the volatility lies and position ourselves to trade with our expiration 2 months out, 3 months out, and we're using options to structure the trades. Nice. Positioning myself. Stock market. Boom. On the Forex side now, we have leverage. Nice. We got lot size. We cannot control the risk more like this, so we can still limit our risk and we can flow with the cycles there. On this side, nice, we use the options, so we don't ever just go out and just buy stocks for buying stocks' sake because it's available or it's accessible. Nice. We want to put the odds in our favor to make certain money. So we want the low risk, high reward over here, and we want the low risk, high rewards over here. We don't want to be blowing up a trading account here. We don't want to be blowing up a trading account here. We understand the little pros and cons between the risk factor, data set, timing, right? The time and all of that. Good, we understand that. And we can still use portfolios in both markets, stack the odds in our favor, and make your money properly. Nice and simple. Alright, so dominating the best of both worlds, it can definitely play in your favor. If you like stocks, you like stock option, yeah, we got some really good education coming on that. Insider knowledge, professional trader, pro trader approach, licensed trader approach when it comes to stocks, portfolio manager, hedge funds. So we learn how to hedge financial markets. We learn how to, stack the odds in our favor, get your edge properly, and trade. Take your time and trade. Protect your capital, preserve your capital, protect your profits, make your money slow and steady. Eventually, accumulate, compound, accumulate, compound, and you're gonna make money over a period of time. Yeah. So this is why we find this Forex market moving much more. As you look at the news events here, that shifts financial markets and stocks. News events here that shift financial market and Forex. This could work for you or against you according to if you know how to apply it properly. Yeah. So it's really, really understanding, how to navigate yourself. So even if things is not rolling, you could still diversify here, and you could always have these here. You trade long term. You could also do value investing here, but as I say, it's a very low risk, low reward, or high risk, high risk, low reward type of a way to do long term investing. The market could be down 30-40%. You studying Warren Buffett and Elon Musk and trying to invest like them. You need to understand those were different times. The market is very dynamic now. We live in a dynamic world. You got to take a whole different approach to stack the odds in your favor for a retail man on the street. You don't have the kind of money like them to do any big value investing. If they go to a hedge fund and give a hedge fund their money, there's traders who build in long short portfolios and trading it, and that's how they get in their money annually. Nice. It's traders who are actually doing the real work instead of just dumping your money out there to work for you without you in something that you don't even understand. People got to study these things, have education on it, if it have the potential to rise long term. Otherwise, it could keep going down while you retire. The money, the contract expire worthless, or the investment is just worthless because it's down 40-50%, and the market is not recovering. You retire, ready to die, and the market didn't recover yet. You're still trying to buy stocks, thinking that the price is going to go up. It's really, yes, baby, my little love. Alright, so guys, learn this good stuff. Learn more at Fishing for Pips. Let's go. See you guys on the inside.